China, India, and Brazil have reduced their holdings of US Treasury bonds over the past year or so. In the 3 years prior to Donald Trump assuming office as US president for the second time, Japan offloaded a chunk of its holdings of these very bonds before shoring up on them again all through 2025. What do these changes signal? Is it possible for countries to weaponize their holdings of US Treasury bonds for economic benefit? Hello and welcome back to Business Matters as the Hindu with me, K. Bharat Kumar. Foreign holdings of US Treasury bonds reached a record peak in November 2025 according to the latest available data. Japan occupies top slot with its holdings totaling a value of $1.2 trillion. The United Kingdom occupies second slot with $890 billion worth of bonds. Asked about reports that indicate a possibility of European countries starting a sell-off trend of US Treasury bonds as a countermeasure to America's quest to take over Greenland, which is a part of Denmark, US Treasury Secretary Scott Bessent dismissed the speculation as a false narrative according to a Bloomberg article. A Seeking Alpha report cited a Deutsche Bank note which said that Europe, as America's largest lender, holds considerable leverage as European countries own $8 trillion worth in US bonds, which is nearly twice as much as the rest of the world combined in holdings of US government bonds. Though countries are unlikely to act all at the same time in this manner, this is not something that has not happened before. China, which occupied the top slot earlier in terms of a foreign country holding US Treasury bonds, is now at number 3. In about a year, its holdings have declined from a value of $768 billion to $682 billion. The latest data was in November 2025. This is an 11% drop. Brazil too has seen a decline from $229 billion to $168 billion, a sharp decline of about 26%. And India's holdings slid 20% to $186.5 billion in November 2025 over the same period. What does adding to or lowering the holdings of these US Treasury bonds by a country, what does it mean for the country that is the bondholder? A US Treasury bond is a debt instrument. So the US government issues bonds in exchange for funds that it wants to raise and pays the bondholder interest for a fixed period, a certain tenure. So if you are the investor, it's like placing your money as a fixed deposit in a commercial bank, getting a certificate saying, yeah, your money is with me. That's what the bank gives you. And then the bank pays you interest at certain intervals through the tenure of your deposit. Likewise for the US Treasury bond. And if you do not want to hold the US bond to the end of its tenure, the tenure is fixed by the US government. If you do not want to hold that long, 5-year, 10-year bonds or whatever, you're free to sell it in the secondary markets. When countries purchase these bonds issued by the US government, it strengthens the US dollar. One, it means that the country that wants to buy these bonds has to buy US dollars with its currency and then secure these bonds. So when demand goes up, it obviously lends strength to the dollar. It also helps countries that buy these US Treasury bonds to keep their own currencies at a lower level, thus helping their exporters. Conversely, when there's a large sell-off trend of these bonds, this tends to weaken the dollar. Additionally, there is a corollary to it. So when bonds are being sold off, which means the demand for the bonds is low, obviously the price of bonds, as Economics 101 would tell us, the price of these bonds starts declining. And once this happens, as a corollary, the yield or the rate on those bonds starts going up. So when the US government wants to raise further funds, the yield rate that is seen on these bonds becomes the benchmark for future transactions that the US government wants to make in terms of raising funds. So it will be a costly affair for the government because it will have to raise funds at a higher interest rate, which is not ideal. You always like to have as low an interest rate as possible if you are the borrower. For investors in general, government bonds and certainly US Treasury bonds are seen as a low-risk, safe investment option that will help them earn regular interest. This is because the US government is seen as a very secure borrower because no matter what happens, it has the capability to raise further funds if necessary to pay off past bondholders. Now, let's come to these 3 large nations which form a part of the BRICS composition. China, India, and Brazil. China, India, and Brazil, the trio, have actually lowered or reduced their holdings of these US Treasury bonds as indicated earlier in this episode. Not only that, India and China have also been adding to their stash of gold. In India's case, the value of gold as a portion of foreign exchange reserves has gone up a significant 66% between January 17th of last year and January 16th of this year to about $113 billion. Now, economic retaliation is not the only reason why a foreign country that holds these US Treasury bonds starts selling off part of its holdings. Market buzz has it that Japan has enough reasons of its own to start selling part of its holdings of these bonds. This is unlikely to happen, but here's where the probability is increasing. Japan is not only a foreign country that holds the highest in terms of value and portion of US Treasury bonds, but it's also a unique example of a country whose own sovereign bond yields have begun rising recently after years of slumber. Recently, government's 10-year government bond yields touched 2.18%, which is the highest since 1999. As we explained earlier for the US, likewise in the case of Japan, as bond yields increase, it indicates an environment where interest rates are high and it becomes costly for that government to raise further funds. And if this pressure on Japan, in this instance Japan, if the pressure persists, then it could slow the pace at which Japan keeps adding to its stock of US Treasury bonds. And at some point, if it becomes too costly for it to raise funds, it would rather sell foreign currency bonds, in this case US Treasury bonds, than raise funds at a higher interest rate. Peter Schiff, an economist, recently tweeted on the worst case scenario. He says a quick move for the yield on the 10-year Japanese government bond to 3% is likely. That, he says, could force the Japanese government to sell treasuries, he means the US Treasury bond, to service its debt. The result could be a US dollar and sovereign debt crisis. Got gold? He asks. Gold has always been seen as a safe haven asset, especially when other traditional channels of investment seem too risky. And the central banks of both China and India have done just that. Over the past year, they've shown low confidence in the US economy, but have been hoarding up on gold in that same period, as explained earlier in this episode. On Tuesday this week, spot gold price on the MCX exchange was 146,000 rupees per 10 gram, while MCX silver closed about 3 lakh per kg, 305,353 per kg to be precise. These marked historic peaks. Close to a year ago, that is at the end of January 2025, MCX gold settled at 82,000 rupees, just over 82,000 rupees per 10 gram, while silver ended the month just above 93,000 per kg. These indicate spikes of close to 78% for gold and 227%, that is more than 3 times for silver. And to add credence to whatever we've discussed in this episode, a Bloomberg article tells us that as recently as yesterday, US treasuries fell on concern that the Trump administration's aggressive stance towards global peers will curb demand for American assets. That brings us to the nugget of information we have for you in every episode. Did you know that the earliest known bonds issued by sovereign governments emerged in Venice around the 1100s? Venice issued the first recorded permanent bonds to fund a war against Constantinople. And here's the related quiz question for this week. When did the concept of authorities borrowing from the public begin in India? And here's the answer to last week's question. Before William Knox D'Arcy came to drill for oil in Iran, where did he make his fortune in the 1880s? The answer was he made a fortune in the Australian gold rush. That's all we have for you folks on this episode. If you enjoyed what you saw, do not forget to like, share and subscribe. Until we meet again, have a wonderful time ahead.